All right, we're up to lesson 9 in this financial accounting overview series. And in this lesson, we're going to go through accounting for bonds. Well, I wanted to start off, as usual, with kind of just a real world example, and why not Disney? I was going to say everyone loves Disney. I'm not sure if everyone does, but a lot of people like Disney. If we looked at the liability section of their balance sheet here, we are going to see that they have borrowings in the most recent year of $42 billion. So, Disney, if you look at that, they have a year end of September 30th. I think that's probably kind of the end of the summer season, and that's what kind of wraps up their fiscal year. Um, so $42 billion worth of borrowings. If you look down below, this was a screenshot I took here early in July of 2024, just to look at different bonds that Disney has outstanding and what sort of what sort of interest rates are on them and some different items here. These are not just all the bonds they have outstanding, but they have a series of them, and we can see that the coupon rate, and we're going to learn the coupon rate is the interest rate that is paid on the bond. It ranges anywhere from 8.25% to 2.75%. So they offered bonds at a lot of different interest rates, and that's because interest rates have changed a lot over the last 5 years. These bonds, some of them mature as late as 2096, and they have bonds that are maturing at all points in time. These are just 6 of them. So there's, in this range, some of them are maturing in 2049, and they have some that are maturing in the next few years as well. Bonds are rated an S&P rating of A minus. That's a pretty good rating. It's the best rating is a triple A, so not like in academia where it maybe be an A plus, but a triple A is the best rating, and then a double A is next best, and then an A is the next best rating after that, and an A minus means it's not quite as good as a solid A, and then it goes down to a triple B, and that's kind of the last good rating. When you get down to a double B, that one is not very good. The latest sales price. How much would you have to pay if you wanted to get these bonds? And this assumes that the bonds have $100. Have $100 basically as what they'll pay out at the end. But you can see that the higher the interest rate on the bonds, the more that people are willing to pay for them. This is kind of like the trading price on these bonds. So the higher the interest rate, the more people will pay. And then the bond yields, that's actually something that means if you were to invest in these bonds and hold them to maturity, what percent return would you get? And you can see that it's in the 5 to 6% range for all of these bonds right here. And we're going to learn a little bit more about what that is as we go throughout this presentation. It's meant to be a little bit confusing right now, and because if you're going to acquire a bond that's going to pay you interest of 8.25%, but you have to pay $135 for a bond that has a face value of $100, you're not going to get that full return because you had to pay more. You had to pay more in order to acquire the bond. So just introducing some concepts here. And then as of September 30th, the company had 43.5 billion of fixed rate US dollar denominated notes with maturities ranging from 1 to 73 years and stated interest rates that ranged from 1.75 to 9.5%. So the 43.5 isn't exactly the same as this 42.1. There's probably some of the current debt that's in here, and then I don't know, they might have had some debt that's not in US dollars. So but we can just see what they're talking about a little bit. So just some really high level, just kind of talking about bonds and the way that people would invest in those. Well, an overview here, we're going to define the terminology that's used when discussing bonds. We're going to record bond transactions when bonds are issued and interest is paid at par, at discount, and at a premium. And those will be mainly what we go through. From my personal opinion in this entire financial accounting series, other than understanding the framework between debits and credits, this is probably the most complex lesson. So buckle up, I guess. So define terminology used when discussing the bond. So debt versus equity, first off. So when we're talking about debt versus equity, the advantages of debt as compared to equity is if we borrow money, we don't have to give up ownership to someone else compared to if we issued shares to them. So we retain control. It's generally a cheaper form of financing than providing shareholders with their required return. We saw on the Disney bonds, the yields on those, that was the far right column, was between 5 and 6%. And we're going to learn also I guess let's just go to this point. Equity holders usually want 8 to 12%, but interest rates on long-term corporate debt have been more in the 4 to 6% range. You know, Disney was 5 to 6%, and then also the interest is tax deductible. So if you're paying interest effectively at a rate of 5 to 6%, you're getting a deduction at it. Between federal and state tax purposes, you're probably getting 25 cents back on the dollar for every dollar you pay of interest. It's cheaper to issue debt as compared to equity, and because investors want higher returns, equity investors. Dividends are not tax deductible. Now, the disadvantage is you've got to pay interest payments and principal payments, or you can get pushed into bankruptcy. That's a huge disadvantage. Now, if we want to talk about bonds versus bank loans, we've addressed bank loans a little bit in this class, in this lesson so far. But with bonds, you can raise more money than if you rely on just one bank. And that's because bonds, you tap into basically anyone out there who wants to loan money. And a lot of that happens through individuals and mutual funds and endowments and just different types of investors. So all the different borrowing options out there can reduce interest rates versus if you go to just one bank, now it's just that one bank loaning to you. And they might not want to loan you, in Disney's case, $40 billion, right? Where if they did, it would be really risky. So they do it at a high rate. The disadvantages of bonds, it's going to be a more complex process to issue them. Thus, for smaller amounts, it might not be worth it. Bond terminology, we're talking about secured versus unsecured bonds. Secured bonds are backed by collateral or assets, basically meaning if the company defaults, that the assets can be liquidated and used to pay off the bond, or that even perhaps the bondholders would get the assets. Unsecured bonds, there's no collateral behind them. So, you know, Disney's bonds, I didn't dig into details. They're probably unsecured. Disney has such a strong, powerful name that people are willing to take on some risk to invest in the Disney bonds. But if you had a really small company, when they have bonds or debt or something like that, they usually have to have collateral. So all else being equal, borrowing rates on secured bonds would thus be lower unless you're huge companies like Disney. Then it's not going to make a huge difference. Term bonds versus serial bonds. So a term bond is going to be paid off at the end of the loan with a large lump sum. Serial bonds are paid off throughout the loan, and those are not common. We're going to deal with term bonds, one big principal payment at the end. We're going to learn there's interest payments along the way. Callable, redeemable. Those bonds could be paid off very early, or paid off early by the company if the company wants. Sometimes there's a fee to the company to do so that they might have to pay to the bondholder. Whereas convertible bonds, the bondholder can convert that into stock of the company if the bondholder wants. So it's kind of a form almost like of a loan to the company, but then if the company does well, they can end up converting that to stock so they can enjoy some of the stock gains. You generally will see those only with very risky investments, and that's something that a company might have to allow convertible bonds in order to attract investors. Principal, that's the amount the issuing company must pay off at the end of the bond's term. If we look back at that Disney example, the principal was $100 that it was going to have to pay off on each of those bonds. And when I say $100, that was kind of the base amount, and there was many multiples of that. The coupon or stated rate, that's the interest rate that the company will pay to investors throughout the term of the loan or out the term of the bond issuance. And in Disney's case, that was more of that column off to the left. I think the amounts were between 3 and 8%. The market rate was rate required by investors for the bond of a certain risk or length. Disney, those market rates were between 5 and 6%. Again, Disney had a rating of an A minus. If there was a company out there that was rated as a double A plus or something like that, the rates would be lower because they'd be less risky. And if there was a company that had a rating of a C or something like that, the rates might be 10, 15, or 20% because it would be a risky company. A bond indenture is the legal contract that has all the provisions about the bond. And then the prospectus. So when they're going out to raise these funds, the company creates a document that it can give to potential investors that has information about the bonds. And they all oftentimes will work with investment bankers, especially if it's a multi-billion-dollar bond issuance. Work with the investment bankers who can find maybe some big mutual funds, some big endowment funds who might want to make a sizable investment in the bonds. Well, review question. What is the term used? Oops, bumped it there. What is the term used for the rate required by investors on a bond investment? So the rate required. So see if you have a thought on this one, and I'll go through the answer. It's not the callable rate. That's not really something. It's not really a rate. It's not the coupon rate. That's the rate that they're going to get paid. Okay, it's not the stated rate. That's another term for the coupon rate. That's the rate they're going to get paid. Market rate is the rate that they're going to require, and therefore the rate that they're going to receive when they factor in both interest payments as well as basically kind of what they had to invest versus what they're going to get back. And that part I know is a little confusing right now, the whole market rate concept, and we're going to dig into details on that. All right. Well, recording bond transactions when bonds are issued and interest is paid, and we're going to first do at par. So when a bond is issued at par, the stated rate of interest equals the market rate of interest. This will almost never happen because the market rate of interest is changing all the time, but we need to kind of go through this example to kind of set a theme first. So the company will receive the full amount it is asking for. So let's say you have a company that's going to be issuing bonds, and if they are offering an interest rate on the bonds that's exactly equal to the market rate, they will get dollar for dollar what they're asking for. The interest expense paid on the income statement will equal cash interest paid each period. So Disney, they want to create a new movie, and it's raising $2 million through a new bond issuance. The bonds have a stated interest rate of 6%. They mature in 10 years. They're going to pay interest twice a year. The market rate of interest is 6%. What is the initial journal entry when they issue these bonds? So again, this almost is never going to happen, that market rate is going to be exactly equal to the stated rate. But we just are going to set it as an example. And that's the company has to set a rate at the start of the bond. And then even by the time that it issues the bond, even if it's just a day or two later, right, the interest rates have changed a little bit in the markets. The financial markets are constantly updating. Well, we need to calculate the present value of the principal. So $2 million, and then the present value of the interest payments. Each interest payment is $2 million times 6%, and then the interest is going to be paid twice a year. So we multiply it by 6/12. All right, if the interest payment was going to be paid just once per year, we wouldn't need to multiply that by 6/12. We could just do it by 12/12, which would just be 1. But here, again, 2 million times 6%, that's 120 grand of interest per year, but it's paid twice a year, so each payment will be 60 grand. All right, now what we actually do is we go to these present value tables, and I use these in the preceding lesson if you remember that, and we see the present value of the dollar has a factor of 0.5537. Now what we do here, when we go to this table, we are using the market rate. We're not using the coupon rate. It just so happens that they're the same in this first example, and that'll change in the next couple examples. But so we're assuming that this is the market rate of 6%, and remember, it was a 10-year bond at 10-year bond, and market rates were 6%. But because interest is paid twice annually, it's not like we're just getting paid at the end of the year. We're actually getting paid some of it a little bit early. So we need to cut the market rate in half and multiply the years by 2. So getting 10 payments at a market rate of 6% is kind of like getting 20 payments at a market rate of 3%. And in fact, those will actually be fairly similar. So if you went to 10 and then you went to 6%, 0.5584 compared to what I've got boxed here, 0.5537, they are fairly similar, but they're not exact. So when interest is paid multiple times per year, like twice a year here, we need to double the periods and cut the market rate in half. All right. Then we go to the annuity table. Again, we double the periods, we cut the market rate in half, and we get a factor of 14.8775. All right. 10 years at 6%, but interest is twice per year, so it's 10, we multiply the years by 2, market rate of interest divided by 2. So now what happens then is we take these factors and we say, well, the principal of $2 million, we're not going to get paid that for 10 years. All right, in today's dollars, that is worth $1.1 million. At a factor of 0.5537%, it is worth $1.1 million today. And then those interest payments of 60 grand, basically of 60 grand every 6 months, those the total of those, if you think about, we're going to have 20 $60,000 interest payments, that would be 1.2 million. All right, we're getting paid interest 60 grand 20 times, that'd be 1.2 million, but that's not worth 1.2 million. The present value of that annuity is we have to use the rate of 14.8775, and the present value of that interest stream is 892 grand. The total is $2 million. So when bonds are issued at par, meaning that the market rate is equal to that coupon rate, it is going to be the calculation here of what the bonds are worth will be equal to the principal amount. And this is basically equal to $2 million. It's just some rounding. These present value tables that I had, they actually round, where in the real world you would not round to like 3 or 4 decimals. You'd go out and you'd get exactly $2 million here. But we're close enough. All right. So now what happens then is at the time of issuance, Disney records the following entry: debits to cash of $2 million and credits to bonds payable of $2 million. And then every 6 months, Disney is going to make an interest payment, debit interest expense, and then credit cash, each of those for 60 grand. If you start crossing over year ends, you remember you learned that, and I think it was lesson 4 and in lesson 8, you might actually have to accrue some interest payable. You absolutely would have to do that. I'm not trying to mix that into this chapter. This chapter is confusing enough without having to do that. So, but 60 grand of interest payments every 6 months. And then at the end of 10 years, the 20th interest payment, we're also going to pay principal. So we're going to pay the 20th interest payment of 60 grand. We're going to pay off the $2 million of principal. That should actually be a minus L right there. And then the total amount of cash that will be paid is going to be $2,060,000. So when bonds are issued at par, that's how we compute what their initial value is worth. And then this is what the journal entries are going to look like. So the review question here says, when the coupon rate on a bond equals the market rate, the bond would be issued at what? When the coupon equals market, bond is not issued at discount. It's not at a premium. It's not at a prospectus. That's not a rate. It is issued, we would say, at par. All right. Well, normally almost always the coupon rate is going to be at least slightly different than the market rate when the bonds are issued, and then also when they're traded going forward. So they're either going to be issued or sold at a discount or premium. So let's go through the discount example first. This is going to be some pretty rigorous stuff, and then we'll do premium, and premium is just kind of the inverse of it. All right. Well, when a bond is issued at a discount, the stated rate of interest is less than the market rate of interest. So what this means there is that the company is going to get less than the full amount of what they're asking for, and interest expense is going to be greater than the cash interest paid each period. Let me show an example, and then I'll talk about it before we compute it. So Disney wants to create a new movie, and it's raising $2 million through a new bond issuance. The bonds have a stated interest rate of 6%, and they mature in 10 years. Disney will pay interest semi-annually, but the market rate of interest is 8%. What is the initial journal entry when Disney issues these bonds? So to really simplify this one, let's just say, Disney has when it has a prospectus and it's shopping these bonds out to mutual funds and endowments and things like that, Disney has to list an interest rate. All right. So let's just say it lists an interest rate of 6%, and then things don't get finalized, for a few weeks or something like that. Maybe the 6% that Disney chose, maybe that was the market rate of interest at that time, meaning that of bonds that are of comparable length and comparable risk, people would expect a return of 6%. All right. By the time they issue the bonds, let's just say that market conditions have changed, so people would now expect an 8% return on these same type of bonds. So that implies that there could be other bonds out there from different companies, from Amazon or Apple or Costco or whoever, that would be the same length and the same risk, and they would pay 8%. So it's like, would you invest in Disney and get 6%, or would you invest in one of these other companies and get 8? Well, of course you'd invest in the other companies and get 8, assuming it's the same level of risk, right? But you wouldn't necessarily say, well, it's not like I won't invest in Disney, but I will invest less in Disney than these other companies. I won't give you $2 million for bonds that are not paying a competitive interest rate. Let's compute what they would be given. So here we're again using 20 periods, but we're not. But the market rate is 8%, and we're cutting that 8% in half. That's not the coupon rate. When we go to these tables, we're never using the coupon rate. It just so happened in the last example that it was the same as the market rate, but we are using market rates, and with interest paid twice a year, we're cutting them in half. And then the present value of the annuity, table 2 here, 20 periods, and again, that 4%. So when we go to put in the present value of the interest, we're going to use the 13.5903. Well, here's your answer. Principal, $2 million, is worth $912,000 today, assuming that market rate of 8%. The interest of $60,000 per period is worth $815,000 today. So these bonds are worth $1.7 million today. Remember, when they were issued at par, they were worth $2 million. The par example was that the bonds were offering a 6% interest rate when the market said, yeah, 6% is right. Here, the bonds are offering a 6% interest rate when the market is saying you should be paying 8. Okay. Now, and then that's where people are like, well, okay, we'll still buy your bonds, but we're going to pay you a little less. It's just like if you go to McDonald's for a hamburger versus a fine steakhouse, it's a couple, it's some cuts of red meat or whatever like that. You're going to pay less. It's not like you won't eat the McDonald's hamburger. You're just going to pay less for it than you would for a New York steak at a fine steakhouse. All right. Now, using Excel on here, we've got $2 million of principal, 6% stated rate, 8% market rate, 10 years, 2 payments per year. There's the present value, $1.7 million. It's slightly different when we use Excel. That's $218 at the end, the total. This is $193, and this is because Excel doesn't round like the present value tables does. So this is technically a little bit more accurate. And then here this is what you would actually do in Microsoft Excel. If you were using this, you would put in the principal and the stated rate and the market rate and the years and the payments per year, and you would type in this formula right here. So I'm not going to go into that and do it, but this is just saying if you were to do this in Excel, you would just input in these key factors. You would use Excel's present value formula, and then it would compute the value of these bonds today. All right, so if they're selling at a discount, Disney gets $1.7 million roughly of cash. So it kind of looks like there's a loss of $271. But they're not like losing money because they're going to be paying less interest than if they'd offered bonds at 8%. So just kind of think about that. Disney gets $1.7 million today. They got to pay out that $2 million. So it looks like they're losing $271,000, but the offset, they're only paying interest at a 6% rate when the market is saying you should have paid at 8%. All right, so it's not a good nor bad. It's just where things are at that way. As this loss occurs over a 10-year period, we don't want to record the whole loss on day one. That would be easy, okay? But we set up a temporary discount account, and this loss will be recorded through additional interest expense. Again, is it bad to have a loss? No, they're going to pay out less in interest. So the journal entry at the time of issuance is cash, and then it's a discount on bonds payable, which is a contra liability, and the bonds payable is $2 million. All right. When they were at par, we did not have that discount account. Now, the example, when interest payments are made, the credit to cash does not change compared to if the bonds were sold at par. We're paying the same amount of cash because that's based on the coupon rate. Coupon rate is the cash payment. Market rate is used when we compute present value. The simple approach would just be to say, let's just amortize that discount over the number of periods. We'll just say it's a $271,000 discount over 20 periods. So let's, instead of claiming the whole $271,000 as a loss in year one, we would just kind of claim a loss of $13,000 every payment. And as opposed to calling it loss, we could call it interest expense, right? That would be a theory of what you could do. So then each period you would just debit interest expense, credit bonds payable, and credit cash. All right, so you just add that amount. It's kind of like that loss spread over 20 periods. You would add that to interest expense, and then you would credit cash, and then the discount on bonds payable. Remember, that started as a debit, as a contra liability. Here it's a credit. It's a positive liability. It will eventually go to zero by the end of the bond's life. All right, and then when the bond is fully paid off, the discount is gone. The total interest expense would have been $271,000 higher than if the bond were issued at par, and we'd be all good. The tweak on that, and this is a complex tweak though, is companies generally use the effective interest rate method. All right, so that was the straight line method I just showed you, but they really don't use it. They use effective interest rate method. So interest expense is going to be based on the carrying amount of the bond multiplied by the market rate. The carrying amount of the bond is the bonds payable minus the discount or plus the premium. If the market rate is 8% and interest is paid semi-annually, the market rate is 4%, and then cash is simply still going to be the cash payment. All right, that interest expense and the discount is going to then be amortized. It's going to be the difference between the interest expense and the cash. I know that as I read that slide, that's pretty confusing stuff. So we've got to reinforce this with an example. So the first payment, we take the carrying amount of the bond, which at the carrying amount right here, it says is the bond payable minus the discount. And at issuance, it's just equal to the amount that you got for the bond. The 1,728 times 4%, that's the market rate of 8% divided by 2, 69,000 is going to be the amount of interest expense. 60 is your cash payment. So 9,100 is going to be the amortization of the discount. The second payment, the carrying amount of the bond, is the original 1.7 million, but now we've ended up increasing this liability, and that should actually be indented to be an increase to the liability there of 9,100, so that the actual carrying amount of the bond gets a little bit bigger. Times 4% is 69,494. That's our new interest expense. The cash stays at 60. We amortize more of the discount. And over the 20 periods, the discount starts small, gets a little bigger, and after the end of the 20 periods, the discount will be gone. Same impact as using straight line in the end. All right, but this is what the GAAP rules will instruct you to use. It's confusing, but you can imagine once you have it set up in your system or something like that, it just rolls forward for you. So here's a full amortization schedule, and you can see that it starts at the 1.7 million we got for the bond, and then it ends at $2 million is basically the bond carrying amount. So that just kind of shows that Shows how the discount is amortized over time. Just a small note. I started with 1,728,193 because that's what the issue price would have been if the bond wasn't if we'd actually used Excel on that. So this is how the amortization schedule. The cash payment never changed. The interest expense goes up. The amortization expense goes up, and that would then total up to be that 271 grand, and it would be gone. So the bond less the discount at the end is 2 million because the discount is gone. Well, review question 3, which is correct regarding bond discounts? What do you think about that one? Give this one a shot. All right. No, they're not generally amortized via straight line. It'd be easy if they were, but the accounting rules don't do it that way. Bond discounts are usually not established as credits. They start out as debits. They occur when coupon rate is greater than market. It's vice versa. So yes, they result in the company receiving less cash up front and paying out less in interest over the life of the bond. All right, than if they had actually issued at par. So that takes us through the discount. We basically have the same section for a premium. I'll go through it a little bit quicker because it's just the inverse of what we just did. So when they're issued at a premium, the stated rate of interest is greater than the market rate. The company's going to receive more than they're asking for. Interest expense will be less than the cash paid each period. So if Disney wants to create a new movie and it's raising $2 million and the bonds have a stated rate of 6%, mature in 10 years, and Disney's paying interest semi-annually, if the market rate was only 4%, people are going to love our bonds. If comparable bonds from other companies would only give them 4%, everyone is going to run toward our bonds and where they can get 6%. So what's going to happen is people are going to pay a higher price. So here we take the same 20 periods, but we're doing half of the market rate. Remember, the market rate was 4%, and because interest is paid twice a year, half of that is 2%. So the present value of the dollar is going to be 0.673, and the present value of the annuity table 2 is going to be the 16.35, 20 periods, 2%. And so if the bonds are selling at a premium, the $2 million is worth $1.3 million. The interest payment stream is worth almost $1 million. So in total, these bonds are worth $2.3 million. That's what people would pay us for up front. Now remember, that's not necessarily a good thing that we're going to get paid $2.3 million for bonds that we only have to pay back $2 million at the end. Why? Because we're going to be paying a 6% interest rate on them when we could have got away with only paying 4%. So yeah, we get more money up front, but we pay more interest over the life. All right, so it seems like there's a gain of 327 grand. We don't want to record it all at issuance, so we set up a temporary premium account, and this gain will be recorded through reduced interest expense. The discount had more interest expense, but this is going to be reduced. Is it good to have the gain? No, they're paying out a higher interest rate. So the journal entry at the time of issuance, they get more money up front. There's a premium, and remember, all three of these examples, they're going to be paying out $2 million at the end. Well, when interest payments are made, the credit to cash does not change, right? It's still going to be the 60 grand. That's based on the coupon rate. And the simple approach, again, would just be to amortize this premium over the number of periods. We could take the $327,000 premium, spread it over 20 periods, and then just say, okay, 16 grand of a gain each period, but we're not going to call it a gain. We're going to call it reduced interest expense, which has the same impact on net income as a gain, right? Reduced interest expense brings up net income. A gain brings up net income. So we could do that. We could just do interest expense of 43 grand each period. We would be getting rid of 16 grand of the premium each period, and then we would pay 60 grand of cash each period. But when the bond is fully paid off, the premium's gone. Total interest expense would have been $327,000 more than if the bond were issued at par. Excuse me, it's actually $327,000 less. I didn't have that word right there. It's right after 327. It should say less than if the bonds were issued at par. But we again are going to use the effective interest rate method. So what does that mean? Interest expense will be the carrying amount of the bond multiplied by the market rate. Again, the carrying amount of the bond is the bond payable plus the premium. In the discount, it was bond payable minus the discount. So if the market rate is 4% and interest is paid semi-annually, the market rate is 2%. Cash is simply the cash payment, and the premium is the difference between interest expense and the cash. So the first payment, the carrying amount of the bond is $2.3 million times half of the market rate of 2%. So is 46 grand. 46 grand is interest, expense, 60 grand of cash payment. So the premium on the bonds payable, 13,458. We then get on to the second payment. The carrying amount of the bonds is now decreasing. Under a discount, it was increasing to get closer to that $2 million. Now we're decreasing to get closer to the $2 million principal amount. Times 2% is 46 grand. So interest expense, 46 grand. The premium of 13 grand gets us to the cash payment of $60,000. We would then end up doing that 20 times, and at the very end, our bonds carrying amount would be $2 million. 60 grand of cash paid each period. That's the exact same at par, at a discount, at premium. We can see the interest expense goes down each period. The amortization that we're amortizing goes up each period. We end at $2 million. Well, in summary, the par value is always $2 million. The cash at issuance was more if it was a premium and less if it was a discount. The cash payment in period one was always the same. The yield that investors get equals the market rate. So the market rate was either 6, 8, or 4%. And that's the return the investors are going to get. You know, at a discount, investors are going to get basically a 6% coupon rate, and then they're going to get extra cash because they only had to pay $1.7 million, and the par value is $2 million. So they end up getting 8%, part through interest payments and part by getting more principal back at the end than they had to pay up front. And under a premium, they get 6% interest payments, but they had to pay more up front compared to what they'll get back in the end, so that reduces their return down to the market rate of 4%. And we can see interest expense is highest under a discount, lowest under a premium. Review question number 4, interest expense will be lower than cash interest payments when bonds are issued at what? So when is interest expense going to be lower? All right. It's not at a discount, interest will be higher. It's not at par, interest will be the same. The market, if it's done at the market rate, interest expense and cash payments will be the same. When it's at a premium, we get more cash up front, so it's almost like there's some sort of gain, but we don't call it, we don't recognize it all right away. We recognize it over the periods, and we don't call it a gain. We have it be a reduction to interest expense. Well, that was a lot. You're going to have to practice this one and just to get better at it. But many companies use bonds to finance capital expenditures. Instead of issuing new stock, they can be issued at par, a discount, or for a premium, and they need to record bonds and other liabilities at their present value of the future payments, including both interest and principal. That's what we got. Thanks for tuning in. We'll be back for the next lesson, which I will just tell you is going to be a little bit more straightforward. Take care, everyone.